Hey, we're going to get going here today, and it's all about the livestock markets, and we're just going to talk about some risk protection in here and things to consider, and with the volatility in the markets that we're seeing in both, the cattle, hog, heck, even on the dairy side of it, we got to keep some risk management in mind. So, there's really three things we think that you can look at doing in here, when it comes down to managing risk, and at the top we have is do nothing, okay, because that is always a choice, and to me, I'm not saying it's a right thing all the time, but it's also part of a marketing plan. Now, when we look at different strategies, I want to give you the advantages and disadvantages of each. I'm not saying it's all encompassing, but these are some things that stick out. Where people really like doing nothing at all is it's easy and it's really the cheapest thing to do. You got to ask yourself at the end, was it the cheapest? Okay, if you needed it in place or not. And then the other thing you need to keep in mind is you are not managing risk by doing nothing at all. Something that we like, even on the livestock side of it, I know it's more popular, on the grain side and doesn't maybe fit as many producers. But, cash forward contracting, I mean, that's just a good risk management strategy. I mean, the price that you're going to receive, you're eliminating basis risk out there, and it's relatively low cost to do. A big disadvantage though is you have really no upside potential, and a lot of times you've got some limited flexibility on the delivery, whether if you want to put on more weight or not. The last thing, and we think this is really popular in here and has been gaining in popularity, is LRP, livestock risk protection, and where this has really gotten more use recently is with higher interest rates. Because a big advantage with LRP is you don't pay for this protection until the expiration. And it works similar to a put option where you got a price floor with unlimited upside potential, and where you have that cost advantage is it's subsidized by the government. Now, a major disadvantage to LRP, and a lot of people don't want to talk about this, is it still costs a fair amount to have in place. The next thing is it lacks flexibility, and where we're talking about flexibility in LRP, you have this coverage in place, and the market goes up. You're stuck with that coverage in here right now, especially if you have the entire inventory protected. The other thing that concerns us a little bit with LRP is the timing from when the livestock is marketed. I mean, if you're not hitting that exact time, we're having fluctuations in this cash cattle market where you move $2-4 every week or every other week, so you can miss out on that if you don't have your timing quite right. So those are some things to all consider in here. So now as we look ahead in here right now, we just want to put an example in place for you to help educate you, okay, on some things to consider. So, on our cattle side of it, we've got 300 head of cattle to market. We're going to market them in April of 2024. We're using a market weight of 1,500 pounds. Maybe for some that's a bit high, but that's just an easy figure us to use. And the date we're going back to and using an example of is October 6th. And at that date, we had April 24 live cattle futures at 193.92. Now, when we go down and we look at LRP, we use two different examples. One with a 183.76 floor, which is running $37 a head. The other one is a 191.76 floor, up at $73 a head. We mentioned this disadvantage in LRP that it has to do with the expiration. On this example here is we got an April 5th expiration. Let's say the cattle don't get marketed till 2 weeks later, and on April 5th, we might have cattle, let's say at $1.80, and then all of a sudden April 19th, when they're actually marketed, we have them down at $1.75. You're still only going to get that $1.80 because your LRP expired. Now, as we look at a couple different strategies to consider, the one that we like a lot in the grain and continue to go with, we like it in the livestock as well, is this our 1/3, 1/3, 1/3 program, where we sell a third in the cash, we do a third with options. In this case is with LRP. The last third is doing nothing. Now, with feeder cattle prices going up, something producers are considering is going, hey, I'm going to go 50% cash and I'm going to go 50% LRP. Now, a program that crop insurance agents or livestock insurance agents really like promoting is just going out there and buying 100% of your coverage with LRP and putting the largest policy in place. Okay, and with that is premium driven. They're worried more about selling you premium and getting some price protection in place. The last strategy out there is doing nothing. And as you can see, doing nothing is exactly that. It's doing nothing. It doesn't cost you anything to do at all. So now as we want to summarize our 4 different strategies, on our far left we have where April closing price would be on cattle, and then we have our different scenarios in here. And you can see at $1.80 cattle, if we do our third theory, we're going to end up with just above a 185 average. If we do our 50-50 price pattern where we sell 50% in the cash, 50% with that LRP, we're at 187.60. Our 100% LRP, we're at a 186.90 price. And then our do nothing, we're down at 180. And then on the very bottom, we have the cost on implementing each one of those strategies. Now, we're not saying each one in particular is going to work or specifically for you. You've got to decide, hey, this is the risk coverage, I want to take a look at. That third one for us is always a good starting point. It gives decent coverage in place in here and tends to be fairly cost effective to have in place. As we want to wrap things up in here, this is what it comes down to. What do you want to protect? Do you believe you have risk? Okay, that's the number one question. Then look at ways to protect it. Look for ways that's giving you the coverage you want in a cost-efficient manner. Okay, the next thing is you need to really understand the advantages and disadvantages of each strategy. What is this doing for me? What are my risks? When you go towards LRP, it's important to look at what the subsidy levels are at. That's helping you pick the points in here right now and where you want to may look at coverage. Is your agent just selling premium? That's something you've got to decide, okay? If it's just always the highest price policy, what are they looking to generate for commissions? You go back to our example in here right now, when the LRP, when it's a fifth of the price compared to an all 100% program, the one-third theory, you can tell you generate a fifth of the commissions in there. I think the other thing too is that, feel free to reach out to us with questions or concerns. We're more than happy to walk you through things. And I really want to end you with this, okay? And I know I just had our final thoughts. This is more final in here, and we really got to take a step back and take a look at the cattle markets over the last 20, 30, 40 years. And I had a producer the other day, and he's in his 80s, and told me, well, I've got more cattle on feed, a couple pens, and I said, well, when are you going to stop? He said, I'm not going to stop feeding cattle out. Or he goes, the day I do stop, it'll probably be my funeral. He goes, I don't know what else to do except for to feed cattle. So when I hear that, cattle producers are going to have cattle on feed for a long time, okay? In 1993, we had our peak. The 10-year cycle, we had our next peak in 2003. The following peak in 2000 occurred in 2014, okay? The peak of this next cattle cycle in here is probably going to be 2024 or 2025. My gut would be it maybe could extend a little bit further, and so I'd lean towards 25 because of the drought, okay, and higher interest costs in here right now that could slow the building of the herd. But we're bringing this up as I think as a cattle feeder, you have to really be proactive as we start looking into 2024 or 2025 and for the next 4 or 5 years on having pretty aggressive coverage in place, because we're going to be on the downswing of this 10-year cycle. Okay, it is when things get tough in here right now that we've got to find ways to manage our risk and survive. We've had a good run at it here over the last 3-4 years. That move is probably pretty close to coming to an end. Again, keep this 10-year cycle in mind. All cattle producers should save this chart here that's in front of us. If you have any questions regarding the markets or on livestock insurance, feel free to give me or Craig a call in at the office. Have a great day.